So for a balance sheet for an insurance company's account, we will have schedules starting from 5 ending at 15. Now the first 4 schedules, you know that they have gone to the revenue account, isn't it? Premiums, claims, commission and operating expenses. Am I right? Over here, 1 to 4. And the remaining from 5 to 15 come under the balance sheet. The profit and loss account doesn't have schedules that you have to separately prepare additional notes for, alright, to do separate calculations. But in case of revenue and the balance sheet both, you are going to prepare schedules. Just like we have notes to the balance sheet or notes to the P&L, you will have schedules to be prepared. Okay, so let's take a look here. Share capital, reserve, surplus, borrowings and all that, and then you of course have your assets. So we will try to match this with our 6th problem that we are now going to do, that is in case of Southern Insurance Company, and these balances are given to you after preparing P&L and revenue account. So they've already done the whole calculation. They've brought down the profit and loss account balance in the balance sheet, okay, and now we have to prepare the balance sheet, and some market value of the investments is given, which we are going to see later. Okay, now let's go one by one and see which of the schedules each one of these items are going to fall under. Okay, so let's see here. In case of cash in hand, right, you have something called cash in hand. Take a look at your pro forma, and cash in hand will come under current assets, that is cash and bank balances, right? What is the schedule number? Schedule number 11. 11 is cash and bank balances. Clear? So schedule 11. Now once again, you have to remember a different set of schedule numbers than what we have done in the case of banking, and with a lot of practice you will be able to differentiate between the two. Okay. Next, there is a contingency reserve. Look at your balance sheet, and all reserves and surpluses come under schedule 6, correct? Schedule 6. So contingency reserve, schedule 6. Same way, general reserve is also reserves and surpluses, correct? So schedule 6. Next you have reserve for unexpired risks, fire and marine insurance. Okay. Now you remember how in the revenue account we do this reserve for unexpired risk. We do a provision, right? And we deduct the changes in that provision from the premiums that we show in the revenue account. Okay. These provisions, they are nothing, I mean these reserves are actually provisions, and those come under schedule 14, right? If you see here under current liabilities, you have provisions, schedule 14. Okay, so one effect comes in the revenue account. Of course, we are not doing the revenue account in this problem, but understand that that reserve for unexpired risk, whatever changes we put in the P&L, we put in the revenue account. Okay, the other effect of that will come under provisions. Do not get confused and do not put it under reserves and surpluses. Reserves and surpluses are what? Part of the profits that are set aside, retained profits, but provisions are the provisions that you make to account for possible losses, correct? Any loss might occur, or premiums, people might not pay premiums, so for that matter you make certain provisions, correct? So this is under schedule 14, provisions. Next we have premises, clearly under fixed assets, schedule 10. Share capital, schedule 5, right? Share capital, the very first one under sources of funds is share capital, schedule 5. Then we have sundry creditors 750, which will come under, what are sundry creditors under this pro forma? Can anyone tell me? Schedule number 13, current liabilities, is where you are going to show your sundry creditors. Is that fine? Schedule 13. Okay, let's move on to the next column. You have public deposits. Now, when we normally used to look at banking accounts, deposits would be a sort of a liability, right? People gave us the money and we deposited it, maintained it in the form of deposits. In this case, public deposits mean some borrowing from the public. It's just like you issue share capital, like you issue shares to the public and you borrow capital. Same way, you give the scheme to the public of something called public deposits. Okay, so people invest in that particular scheme and they get a certain interest amount after a certain period of time. Okay, so this public deposit is money that you or your company has borrowed from people. That means it is a borrowing. Schedule 7. Okay, Schedule 7, borrowings. P&L account is what balance of the profit and loss that has been brought down to the balance sheet. Okay, now P&L account comes where whatever balance of the profit and loss account is left, it will be put under reserves and surpluses, right? Always we carry forward retained profits to the reserves and surplus, so it will be Schedule 6. Correct? Yes. Now, mortgage loans, again, where are they going to come? These are loans that have been given. These are loans that have been provided. I know they should have specified it a little more in the problem, okay, because you may feel like mortgage loans are even loans that have been taken from other banks, and it's easily like you may confuse it with borrowings, okay, but these are mortgage loans, that is money that you have given to others, loans that you have provided to others on the mortgage or by mortgaging the insurance policies and so on. Understand that a lot of times people take loans on their insurance policy, right? Loans are possible. A lot of insurance companies provide loans, right? So this loans, mortgage loans, is Schedule 9 and it comes under loans that are given under assets, right? Application of funds. Bank loans are borrowings, meaning you have taken the loan from a bank, right? So you have borrowed it and that goes under Schedule 7. Okay, then loans on company policies are again Schedule 9, loans given. Like I said, all insurance policies of the company on that a certain loans may be given by the insurance company. Okay, next one, outstanding premiums. Now, premiums are paid or received by the insurance company